Okay, real quick before we jump into some of these strategies from siphoning off some of the funds from the business to your personal side, I want to talk a little bit about how you can actually take advantages of this for you as actual W 2 employees. And I'll give myself as an example. So I started in banking when I was 19 years old. And one of the first things that I learned about was the importance of retirement planning. And so since day one, when I started at a bank called Norwest Bank, then became Wells Fargo, I was able to jump right into a 401k plan. So for those of you watching, if you have access to a 401k plan and your company is matching those funds, it's a no-brainer. You definitely want to contribute to that if you're not doing that already. It's free money that the company is matching you with. And we'll talk a little bit about contributions limits, but you don't have to necessarily contribute the max. Every dollar counts. So even if you're not making a lot of money right now, whatever you can start to do is something that will help you out in the future. My rule of thumb is at the very minimum, you should be contributing what your employer will match for you. Because again, that's free money. And in most cases, they will match you what you contribute. In some cases, they'll give you a flat percentage amount, but in most cases, they want to see that you're contributing as well. So at a young age, I started with a 401k. The next strategy that I was introduced to was a Roth IRA. This is a phenomenal way for those of you that are younger that maybe aren't earning a lot right now to start taking advantage of, because here's the reason why. A traditional IRA or 401k, you're contributing before tax funds. And so you actually get a deduction off your income, which will reduce your tax rate at the end of the year. If you're making a lot of money, this is great because that helps you significantly when you do go to pay taxes at the end of the year. But if you're just starting out, or maybe your income is not that much, and then let's say in some cases you're taking the standard deduction instead of an itemized deduction, a Roth IRA is actually going to be a better solution for you. And the reason being is because you are contributing after tax dollars, so you're not necessarily getting that tax deduction today, but what you put in there grows essentially tax free. And what that means is as long as you don't touch it until you're the 59 and a half, retirement age, all that growth, when you do go to pull that out, it's tax free. So it's a significant way for you to build tax efficient assets over a period of time. What I recommend a lot of times with my clients is it should be a combination of the two. No need to do just one or the other. Look at doing both each year when you sit down with your advisor or your CPA or whoever is preparing your taxes for you. Take a look at that financial plan. See if it makes more sense for you to take the deduction now to pay less taxes. Maybe it's in a year where you had significant income, or if it makes sense for you to put the funds within a Roth IRA. Now, there are some things that you need to make sure that you qualify for in order to take advantage of the Roth IRA. So there are income limitations where if you make over a certain amount of income, unfortunately, you aren't able to contribute to the Roth IRA, but there are also strategies that you can use to kind of get around that. But nonetheless, I was introduced to a Roth IRA shortly after the 401k. I took advantage of it. I've been contributing it to that account since then, so close to 20, 25 years now. And so I have an asset that has essentially grown, and that'll be tax-free income down the line. But I also have the 401k as well, so it's a good combination of the two. So again, before we start jumping into these topics specifically for business owners, wanted to make sure that I shared a little bit of that with you that maybe aren't business owners watching this and you're working for a company right now. So attaching a quick story to a SEP IRA, just to kind of give you an idea of how this would work. We're going to use the example of Mary. Mary is a marketing consultant, so she's the only employee within her business, and she earned $250,000 in income from her business last year. By taking advantage of the SEP contribution limit, which in this case, she can contribute up to 25% of her business income to the SEP IRA, she's able to do right around $62,000 to that SEP IRA. So once again, not only does the business get to take a deduction, but she's able to move those funds out and allow those to grow under her personal name. All right, so giving you an example of the simple IRA, let's say we got Dr. Smith. Dr. Smith owns a small dental practice, has 6 employees, wants to keep it super simple, doesn't want to go through all the hassle of setting up a formal 401k plan. He sets up a simple plan, allows him to contribute up to $16,000 for himself into a retirement plan, and he decides he wants to do a match of 3% for his employees' contributions. So, great way, keeping it super simple, allows him to move a little amount of money out of his business into his personal, and then the matching contributions that he gives to his employees. It's a great retention tool for him as a owner of the business, and then also he gets the deduction for the contributions in the matching. All right, now we are going to talk about the power of a defined benefit plan using an example. So let's say we have Gary. Gary owns an architectural firm, and his architectural firm has been generating right around $400,000 in business income per year. Gary's 60 years old, and he hasn't done anything to start putting money aside for his retirement. He's looking to exit his business in 5 years, so he's starting to get super worried about how is he going to be able to fund his retirement without paying a significant amount of taxes when he does go to sell the business. Enter the defined benefit plan. What Gary's able to do is contribute, and this is just an example, $220,000 in year one and build this plan over a 5-year period so that when he exits, there's a good chance he's probably going to have well in excess of $1 million. And again, those distributions that he makes to himself in the defined benefit plan is tax deductible to the business. So utilizing this example, the business is only paying taxes on $180,000. And while Gary is able to get $220,000 into his defined benefit plan. As I mentioned, a lot of this is based on actuarial calculations. So for those of you that might be a little bit older, in this case, Gary's 60 years old, and based on your income, it's a great way that you can structure this to essentially put a retirement plan on steroids and at the same time be able to get some pretty significant tax benefits doing it. Okay, we're going to use a quick example of how utilizing rental income can make a significant impact not only on your tax savings, but also on your personal wealth as well. So we're going to utilize Liz. Liz owns a veterinarian practice. In this case, she does own the real estate in which the business operates out of. And so for a while there, Liz was paying herself about $120,000 a year. That was what she needed to maintain her standard of living. And so she was paying self-employment tax on that entire $120,000. So that 15.3% self-employment tax she was paying on that, plus the additional taxes from the business income. So what she did was she met with her advisor, and what they did is they strategically altered how she was generating her income. And so instead of taking the full $120,000 as income from the business, she had the business pay her rental income in the amount of about $60,000 per year. So what that allowed her to do is instead of paying the self-employment tax on the full $120,000, she was only paying that on the $60,000 she was drawing as a salary from the business. And then she was getting that $60,000 in passive income, which was taxed at a lot lower rate. So again, great example of how you can utilize rental income to help pay less taxes and also start moving some of the funds from the business to you personally. Okay, I'm going to give you a quick personal example of paying your kids. It's a great solution, as I mentioned. So I own an auto detail shop. And over the summer, my son, who supposedly is this phenomenal social media expert, I hired him to do the social media for our auto detail business because I had been posting for a year and I had a whopping 26 followers, which he laughed at. So he said, "Hey, Dad, let me take over this social media for you." So I said, "Great." So I hired him to do the social media. Wasn't paying him a super large amount of money, but it was enough money for him to, want to be part of the business and then also be able to help me out as it relates to, growing the business from a social media standpoint. So everything that I paid him, I was able to write off as a business expense, just very similar to an employee. But the great thing about it was because it wasn't over that $14,600 mark, it was all tax-free to him. So he didn't have to pay taxes on it because of the standard deduction that he would get. So a great fun story for those of you that are business owners that want to include your family in the business, especially during the summertime, maybe when they're not in school. It's a great way to include them in the business and also get some great benefits out of it as well. Okay, so we talked about the gifting strategy. Once again, I'll give you just a quick example of what that could look like. So we'll just use, we'll call our customer Elena. Elena has a manufacturing company that she's helped grow over a long period of time. The business has done extremely well. But what she did early on was she started gifting shares of the business to her daughter. And she was able to utilize up to that exclusion amount, which was the $18,000. And she slowly moved the assets or the shares of the business to her daughter over the course of a 10-year period of time. This allowed a couple different advantages for her to do that. Number one, it slowly moved some of the value of the business out of the estate, which was significant. So there wasn't going to be an estate tax issue in the future, but she also set up a GRAT. And I've talked about this in a previous video, how a GRAT works. But essentially, she was able to gift over some of the shares of the business, lock in the value so that any growth, beyond that is once again going to be estate tax free. It's not going to be part of her estate, and she's able to lock in that value. The business is able to grow and not have a huge tax consequence to that. So that's a great kind of alternative. Like I said, a little bit more complex because you're talking about gifting business shares as opposed to actual cash or securities. But for those of you, again, that are looking at that as a possible strategy, reach out to me. I can kind of take a look at your situation and let you know if that's something that would be of benefit to you. Okay, so for some of you that are new to watching this, I wanted to just take a few minutes to share a little bit behind the scenes about how I got to where I'm at today and a little bit about my journey so you can kind of have an idea of the reasons behind why I share the certain content that I do, why I'm so passionate about it. So I actually got into banking really early on. I was 19 years old. I started as a teller at Norwest at the time, which is now Wells Fargo. Was always fascinated with growing wealth. And so since an early age, I started contributing to instruments such as a 401k, Roth IRA. And I was very blessed to have individuals in my life that were great mentors that kind of guided me through this process. So I'll never forget, I actually had a really good investment advisor at the time that sat down with me, explained different types of investment options, how a Roth IRA worked compared to a 401k. And so I was able to set those plans up early on. And over the course of 20 plus years, those accounts grew to pretty substantial amounts. And it wasn't a situation where I was contributing a lot of money at a time. It was just a little bit every single year. And one of the things that I would say for those of you that are starting on early in your career, it's the 401k match is probably the most beneficial way for you to start putting money aside for retirement. If your company does offer a free match, highly recommend that at the very minimum, you are contributing an amount that's equal to that match so that you're not leaving any type of free money on the table. So fast forward a little bit, slowly but surely, I was able to build up some wealth. Actually was able to purchase my first home at the age of 20. And fun story behind this, I actually purchased this with my tax refund. So it's the only time I asked my dad for a $5,000 loan. The house that I bought was $120,000. Bought it through an FHA program. And so the total out of pocket was $5,000 to me, right around the exact amount of money that I was getting from my tax return. And so I had asked him, hey, can I borrow the $5,000? I just need it for 2 months till I get my tax refund. So that's how I bought my first house. From there, I was able to slowly build wealth through real estate. So for those of you, again, that have not maybe got to that point where you're looking at alternative investments outside of your standard securities in a standard retirement accounts, real estate's a phenomenal way for you to build wealth. Over the course of time, I actually bought and sold 4 houses, each time rolling the equity into the next home. So one of the things that you'll learn in most markets, now, it's a little bit stagnant as far as the values of the housing market today. But in most situations, that value of your home is going to continue to increase. And as you upgrade, maybe you have a family and you need a bigger house, or you move, like in my case, I relocated actually a total of 3 times. And so needing to purchase a new house, you can essentially roll that equity and that continues to grow over a period of time. So I was very fortunate. I bought my first house here in Phoenix, which is where I'm from. I was then relocated to a new company out in Dallas, which is phenomenal. Love Dallas. And we bought a home there. Once again, rolled the equity into that to be able to purchase a home there. Cost of living there was phenomenal. Then I got relocated to San Diego, which is amazing. For those of you that have been to San Diego, you know what I'm talking about. Was a big shocker when I looked at the cost of living, because for what I sold my house for in Dallas, I could maybe buy like a small little studio apartment, but was again very fortunate enough to have enough equity in that home in Dallas to where I was able to roll that into the house in San Diego and be able to purchase that house there. From there, I was in San Diego, once again relocated to Orange County. Same strategy, just continue to roll that equity into the next house that I had in Orange County. And this is where I started branching out to look at investment real estate. So this entire time, I was investing in real estate from a primary residence standpoint. So the houses that I own, or the house that I owned and lived in. But in 2018 is when I bought my first rental property here in Arizona. And so I was able to save up funds to be able to purchase that here in Arizona, and started, building that experience around generating rental income through real estate. So over time, I was able to then purchase my second one a couple years later here in Phoenix as well. And then in 2020, I relocated back to Phoenix from Orange County. And at this point, because I was moving from a very high cost of living area like Orange County and coming to Phoenix, which was a little bit more affordable, not so much anymore, because a lot of us Californians moved from California to Phoenix, I was actually able to buy another 2 homes, believe it or not, for the price that I sold my house in Orange County for. So then I got to a point where I'm at now, which is having a total of 4 houses, 3 of which are investment or rental properties, plus my primary, to be able to grow that wealth. So just to kind of give you an idea, I mentioned this at the beginning, I purchased my first home for $5,000 down, ended up getting to a point where I had probably close to $1 million in total equity between all of the homes. So for those of you that are looking at different ways to build wealth, real estate's a phenomenal way to do that. But it's also in conjunction with some of the other instruments that I mentioned, such as the 401k, Roth IRA, great ways to start looking at how you can start building wealth for yourself. So real estate, I ended up, like I said, owning 3 homes. I currently own 3 homes that I generate investment income from. Was very fortunate here in Phoenix. We had a pretty huge increase, like most areas across the country, back in 2020 through basically 2024. Home prices increased pretty substantially in value. One of the things that I would say for those of you that do own real estate to consider is when you do sell the real estate, you are paying long-term capital gains tax as long as you hold it for more than 2 years. However, for your primary residence, there is an exemption that you get as long as you've lived in the house for 2 years. You can actually reduce the capital gains on your home up to $250,000 if you're single, up to $500,000 if you are married. So one of the strategies that you could look at is, if you do have investment property, if you relocate into one of those investment properties, you live in that property for at least 2 years out of 5. So what that means is, like, let's say you lived in there for 2 years, you could sell it. Let's say you rented it for 3 years and moved in for 2 years. As long as it's 2 years within that 5-year time period, you can actually sell that property. And in most cases, I would say you probably won't have to pay any capital gains tax. So there's a couple different strategies, again, from a real estate standpoint, where you can not only get the larger gains, but you can also get some good tax advantages from that as well. So all of this to say that, I've built a good amount of wealth over a period of time. I'm very passionate about helping others do this, whether you're at the beginning stages and you're trying to just figure out, what the difference between a stock and a bond is, all the way up to if you are looking at more complex strategies, everything from estate planning to tax mitigation, any type of areas, especially if you're a business owner. That's where my specialty lies. About 2 years ago is when I started my first business. I now have 2 businesses. So for those of you that are entrepreneurs, I definitely feel what you go through on a regular basis. It's not easy to be a business owner, but from a wealth standpoint, it's also one of the best ways to build wealth over a period of time. And so For those of you watching, that's just a quick background on me. Why I'm doing what I do is because I want to educate those the way that I was educated. Had some great mentors along the way that have helped me in terms of getting to where I'm at today. And so if this is useful for you, or if you have any questions, I'm always open to help. You can reach out to me. You can direct message me. You can find me on LinkedIn. I try to do a good job of posting a mix of different types of financial literacy topics. Again, most of it's going to be targeted towards business owners. That's really where I cater to, and that's really where I do a lot of the planning. One of the things I didn't mention is I did get my certified financial planners designation a couple years back. For those of you that aren't familiar with that, it's an extremely in-depth process of getting to know and understand several different aspects of financial planning. As I mentioned, everything from estate planning, tax mitigation, risk management, retirement planning, and there's other components as well that go into that. It's a very intense test that you have to pass in order to get that designation. And so that's also an area that I can bring value to all of you that are looking to get some advice or some guidance. And a big part of that also, and I forgot to mention, is business succession planning. So I'm pretty well versed on every which way that you can exit a business, not only for maximizing the value of the business, but also from a tax efficiency standpoint. So I can help you in those areas as well. So we're going to go over a few topics throughout this series, every different type. If there's something that you want to learn about, drop it in the comments. I'm always looking to figure out different ways that I could add value to you. So if there are certain areas that you want to hear more about, certain topics, I know crypto is the biggest thing right now. And while I don't know a lot about crypto, it's not really something that's, my cup of tea. If there's anything in particular that you see that you want to learn more about, please drop it in the comments. You can reach out to me directly. Again, Anthony Perez, Harvest Wealth Strategies. Whatever we can do to help, just let us know.